Also back with us, I should say, Brian Belski, Managing Director and Chief Investment Strategist at Oppenheimer Co. He is among the most bullish U.S. stock strategists, and he says today's decline is overdone. So, Brian, let's start things with you. I mean, it's overdone. How much is it overdone? Because we've seen some pullback as of late.
Well, you've seen the market kind of come back and forth so far today. I think that one of the major points that people are missing is we're so focused on what's happening in Greece and what's happening in Europe and what's happening with the euro that we've taken the eye off the ball on what the good news is. And the good news is it's time to be back in the U.S. And
but wait a minute. I got to break in here because Greece is a big story.
It is. Now think about this.
Why is it not?
What is it? 10%? Is Greece's economy growing or contracting? And has it been contracting for a long time? It's been contracting for a long time. Is the United States economy growing or contracting? It's growing.
But what if we get that contagion effect? Doesn't
the contagion
that impact?
effect is more like we're all chasing the ambulance right now. We're being so reactive to what's going on. Remember 1997?
You're not worried at all, are you, about that?
You should be psyched, actually, because what you're saying, everything's going great here in the U.S. We're seeing awesome earnings this year and for next year. The recovery is going to be strong. You need people out there to be bearish and worried to help you get into this market.
Here's the bottom line. Fundamentals drive stocks, period. Period. Okay? Prices lead earnings, which lead the economy. Prices went up big last year. Here come earnings, and then here comes the economy. It's a classic type of move. And people are missing it, and people are doubting it. Why? Because the last 10 years, everybody knows that equities have underperformed bonds. The last 10 years, everybody knows that the U.S. has underperformed everywhere else. But guess what? The sea is changing. We have too much exposure to non-U.S. assets. It's time to come back here where the stability is. We have the cleanest corporate balance sheets in the world right now, the cleanest they've been since the 1950s. I like it because we have a 1,300 target on the market. We think inherently that stocks are going higher. I think the biggest thing that people are missing, not only from the U.S. providing stability, is this. Currencies are about the economy. Currencies are about the economy. We had investors leave the U.S. because our economy peaked out in the late 1990s, right? And they went everywhere else for growth, albeit Russia, China, India, Eastern Europe. Now growth is beginning to come back here, but we're still so focused on the assets that we made all this money in the last 10 years, we can't get our mind off that. That's why we're still trying to be so focused on what's happening in the euro, and we're missing the ball here in the U.S. It's a classic buying opportunity, and that's the time when you want to buy equities.
Guys, is everyone too bullish? Is that part of the problem here?
Well, I'll answer that first. I mean, we were the first people to have a 1,300 target on the market this year, and we take great pride in that, but we get there in a different way. Many of my competitors are very bullish on international growth and non-U.S. assets. We're bullish on U.S. assets. That's how I think we get to 1,300. And so I do think that there's too many bullish forecasts out there, but we get, as a strategist community, we get there much differently, and that does not take place in as transparent in that type of analysis.
How do you get there? I mean, what are your earnings estimates? What are your PE expectations?
Well, PE expectations are, again, prices lead earnings, which lead the economy. We think earnings are going to be up more than prices this year. We think earnings are going to be up to the tune of 35 to 40%. Our official number is $76 on the market this year. We think that's a little low. It's going to come up. The way that we like to manage our business in terms of earnings are we'd like to put a number out there and be able to upgrade it, not downgrade it. So we think the ultimate number is probably in the low 80s somewhere.
Andrew, the Senate voting to ban tax-funded bailouts of Wall Street firms, which we already know, but the vote, well, we knew that the package was created. The vote has now gone through. Bailout ban to allay Republican concerns about a financial bill. That's the point of it, right? But we know, of course, if any giant Wall Street firm were to fail, we would have to bail them out, wouldn't we? They're also interconnected. I mean,
right. I mean,
you can't just let them fail if it brings down the entire U.S. economy. Maybe they should craft some legislation to avoid that problem altogether.
Right. I mean, I think there's still structural problems with financials, but by and large, the majority of the really bad issues are behind us.
I'll ask you guys, though, because I've got a viewer writing in and saying, you know, they're listening to your bullish comments and they're saying, you know, you're completely glossing over the fact that government stimulus has really helped fuel this rally and also all of the quantitative easing. I mean, we have had guests on, Brian, that have said once you take that away, there's a lot of questions about what the outlook is, whether it's for the economy and corporate earnings.
Well, remember, it's about 60% of the stimulus is still sitting in the coffers of the Federal Reserve. Not many people know that, and the economy has already turned positive, so that's good. So when you have a rising dollar and a rising economy, a lot of the deficit issues are going to be fought off. And I guess the bottom line is we're not going to end up using a lot of that stimulus, and I think that's what people people are missing on that.
But what about all the states here who are looking at their budgets and they're looking to make a lot of cuts? I mean, we just had someone on or someone mentioning about that they're looking at all those either teachers and state workers who are going to be laid off and the problems that that's going to cause. We haven't even gotten to that point.
We know that government really is not quote-unquote the best manager in terms of their resources, right? There's a lot of fat that can be cut. And
right, but we don't need more people unemployed at this point.
We don't need more people unemployed, and unemployment, we think, has already peaked, but it really depends upon where you think normalized employment should be. We actually think it's probably closer to 6 to 7% unemployment, and I think the 4% rates that we saw in the 90s just are not sustainable.
I do want to weigh back in with financials, if that's okay with you all. Brian, and I want to ask you, I mean, Meredith says she would get in here potentially if valuations fell. Of course, she was saying she didn't like banks a year ago when valuations were pretty much at the bottom of where they could be. But where are you on whether banks are expensive right now?
Well, we actually just downgraded mid-cap financials from overweight to market weight, given the fact that this is one of the best performing groups in all of the industry groups within the S&P 1500, the broader spectrum. So we've seen a tremendous amount of valuation expansion there. We think actually the regional banks are the best place to be, given the fact that when and if employment comes back, I mean when employment does come back, C&I loans will pick up, and therefore the bottom line to those banks will be the most exposed to the upside. But the bottom line on the financials are we've had this great reallocation effect the last year or so. In the first quarter of 2009, less than 5% were the holdings of the majority of U.S. portfolio managers in terms of financials, and now they're around 15 to 17%. That really happened between March and June 1 of last year. Now we've seen the financial sector gain about 2% in terms of market cap since then, and the majority of the upside has already been contained. We think that there's a lot of structural issues that face financials in terms of too much capacity that need to be fought off over the next several years. But by and large, we think the lows are in place. Valuation's a little expensive. We'd be very, very selective. I think it's going to be very much so a stock picker's market within financials for the next several quarters.
All right, Brian Belski at Oppenheimer. Brian, one thing I keep wondering, I mean, is there a point on Friday when we get that jobs report that will be strong enough? Could we get a number that's strong enough that kind of pushes Greece and the other concerns to the back?
Sure we could, but remember, as we've been talking back and forth, everyone's being very reactive. We're focusing on every little tick, and that really provides opportunity. Let's focus really on the fundamental improvement of the economy, which we think we're going to see additional data to the jobs numbers on Friday, just like we saw some incremental data today with respect to both the ADP and the Challenger numbers.
All right, hey, Brian, thanks so much for joining us.
Thank you.
Brian Belski there.